title of the panel is Financial Integration as Boon or Bane, Banking Union and the Elusive Quest for Growth. Before we start, given that the aim of GPPF is to bring together people from academia, the political arena, and market practitioners, I would like to share with you a couple of thoughts from my experience as an investment banker. I think that the beauty of finance and economics is that ex ante is extremely difficult to predict what is going to happen, and ex post you can find thousands of theories to state the obvious. And I am quoting here one of the greatest decision makers in finance, and I would let you find out who is this guy. Recent regulatory reforms coupled with innovative technologies has stimulated the development of financial products such as ABS, CDO, and CDS. ABS stands for asset-backed securities, CDO is collateral debt obligations, and CDS is credit default swaps that facilitate the dispersion of risk. These increasingly complex financial instruments have contributed to the development of a far more flexible, efficient, and hence resilient financial system than the one that existed just a quarter century ago. Will you guess who is the guy that used this quote? Greenspan. It is Alan Greenspan, 24 months just before the collapse of Lehman Brothers. And this is part of an approved speech approved by his committee because it was in one of the speeches that he gives following the Committee of Federal Reserve. And then a second thing, which I think, unfortunately, you cannot see it very clearly here, but I think that we discussed it a little bit yesterday, and I feel that many people, decision makers in Greece, also they are not correct about that, is that they feel that if Greece had its own currency and if it had devalued, then the whole process it would have been much easier. And here I am depicting Euro GBP. Since 2007, the British pound has devalued approximately 30% compared to euro. On a traded weighted average basis, it has devalued 20%. And despite that, the exports of Britain have grown slower than Spain and Greece. I am opening now the discussions with Professor Rodrigo.
Hello, good morning, everyone. I would like to start thanking the organizers, thanking the sponsors, and Kenny Beach Resort for hosting this event. It's a pleasure to be here, to be back here in Kenny, to be welcomed by the organizers another year, and hopefully the next one to come, to share my thoughts on some of the issues that are happening.
It's an open invitation.
Let me start by apologizing to participants, because with the organizational committee, we had a discussion early, particularly with Nikita, to talk about the IMF policy on sovereign lending and a little bit on touching on lending on arrears. That's what we discussed, that's what we have agreed, that's even the brief that I submitted to the website. But then I appeared on a panel on the banking union, and discussing with the chair of the panel, Mr. Kiriakos Papadakis, he suggested that it would be better to do something on banking union. So that's why there was kind of a last-minute flip in the air, and now I'm moving to banking union. Having said that, my presentation will talk about economic monetary union, a strong E, but a weak U. That already gives you a flavor of what I will be touching on. Let's look a little bit backwards, how all this started. Basically, the crisis, the subprime mortgage crisis, started in the US. It soon took hold of Europe and the whole world alike. The symptoms were more or less the same. Very similar symptoms, because there was links between retail market for mortgages and wholesale markets for asset-backed securities, structured finance, basically what these links to the quote that Kiriakos was mentioning about ABS, CDO, CDS, etc. And basically, there was a spillover from the banking crisis to, and in Europe, this financial crisis, this kind of morphed from a purely banking financial crisis into a sovereign debt crisis. Whether there's a sovereign debt crisis or a banking crisis, that depends a lot on each particular sovereign that we're dealing with. And here, there are just, I have kind of put them in different boxes. The reality that you are telling, yeah, but we also have others like Spain or Cyprus. I personally think that those are kind of more of a hybrid. Clear banking crisis, Iceland and Ireland. More of a sovereign budget deficit crisis, Greece and Portugal. The other two, I think that for me at least, they're kind of hybrids and they have elements of both. The point I'm trying to make with this is that everybody said, okay, yeah, there was this financial crisis and now we're in a sovereign crisis. No, the origin of all the crises are different and there are many particularities for each one of these cases. I'm not here to discuss sovereign debt crisis, so basically I'm just mentioning this, then if you want in the Q&A session we can develop this further. Let's look a little bit about this one because what we are moving is towards a discussion on the banking union. Let's talk a little bit about Iceland. Iceland in a nutshell, and basically I'm keen and conscious of time and I want to keep my presentation as short as possible. Because I think that we can gain much more from the open discussion, but basically here you have more or less what happened. It was a crisis, it started as a banking crisis, immediately it morphed into a currency crisis. This currency crisis escalated to a sovereign crisis. It had several international connotations, and basically, this is the lesson learned from Iceland. The banks were too big to fail, but at the same time, too big to be saved. That was the problem with Iceland. Ireland, what happened in Ireland? And again, being oversimplistic, it quickly felt the effects of the global crisis. The Irish banking sector was concentrated in the hands mainly Bank of Ireland, Irish Bank, and Anglo-Irish Bank, which held 80% of the retail market. The level of lending growth over 200% from 23 billion in 2005 to 72 billion in 2008. And basically, these are some of the conclusions from the Commission. Anglo was essentially a monoline bank focused almost exclusively on commercial property. And 85% of Irish nationwide building society was commercial property lending with growth from 2 billion to 9.8 billion. So this clearly is showing the importance of the retail mortgage market in Ireland. If we do a brief parallelism with what happened in the US with the subprime mortgage crisis, we knew what would be the outcome in Ireland with a market which was only, or not only, but mostly focused on retail mortgage lending. So basically, the relationship between banks and sovereigns needs to be looked holistically in the line of the independency of banks and their sovereigns. As we all know, capital is the lifeblood of both banks and sovereigns. And basically, banks exist within a perimeter of rules that are governing their activities and their solvency. Sovereigns, on the other hand, work with a much more informal structure as to what are the rules regarding solvency. And also, there's another issue, which is the solvency of a state, of a sovereign state, is something that, from a purely theoretical point of view, and mainly here wearing more of a legal hat, it cannot be tested. Why? Because there's no insolvency regime, there's no bankruptcy regime that applies to sovereigns. So who is going to determine whether a sovereign is insolvent? No, there's no competent authority to determine, okay, a sovereign is insolvent. You can claim, yeah, but it's a financial condition. Yes, it is a financial condition. You can argue it's a financial condition if you are not wearing the legal hat, and you can say, yeah, it's a financial condition. Okay, but can a sovereign be insolvent? A sovereign can keep on taxing its citizens. A sovereign can even start taxing future generations to come. You're telling me, yes, that would not be politically correct. I'm not a politician, I'm an academic, so I can tell you from a pure theoretical point of view, this is perfectly possible. Okay, let's put that on the side. Okay, I'm going to say something that some of you might get upset, but basically you can sell a piece of land, and I'm not implying anything, that don't do any free association between what I'm saying and selling a Greek island. That's not what I'm planning to say, but it has happened in the past with the state of Louisiana, with the state of Alaska in the US. Is this a 21st century concept? Probably not, but again, from a purely legal, for a purely theoretical point of view, it's perfectly possible. We can always confiscate assets. So, at the end of the day, again, from a purely theoretical point of view, a sovereign cannot be insolvent. The problems of both banks and sovereign can give rise to systemic risk and contagion to different degrees, and not only within one sovereign, but to neighboring countries. And again, we can look back in history in the 90s with the Brady Plan. We can look in 2001 when Argentina went down, Argentina pulled Uruguay, or what's happening now in Europe. And believe me, not just Europe, but also this is affecting the main trade partners of Europe. 2 weeks ago, I went to visit a sovereign because they are experiencing problems. And when we start looking into the composition of the balance sheet, basically you realize that 65–68% of the trade is with the EU. And that explains a lot why they are concerned, why they have been recently downgraded twice. And that already gives you that this showcases the fact that it's not just a European phenomenon. And basically, there are many linkages between the banks and the sovereign, both at the domestic level and the sovereign level. And why they say, okay, the financial crisis morphed from a banking crisis or a financial crisis into a sovereign crisis, that's mainly because several times, or most of the times, when there's a crisis in one of the two, indirectly affects the other one. But again, I want to highlight that the origins of the crisis are different. Having said that, with this slide, which of course is borrowed from the New York Times, it's not mine, here what you can see is the cross-exposure of the different main players within the EU, or not necessarily the main players, those that are more affected with the crisis. And you see here the broad arrows, and those represent the exposure. If you look, for example, at Italy, basically the top arrow is Germany with 190 billion, France 511 billion, and Britain 77. I can provide you electronic copies if you want, because here it's not seen very clearly, but that just to give you a snapshot to show the cross exposure between all these sovereigns. And now we're going to talk a little bit about the different austerity programs and basically what has been the EU response to the crisis. In the case of Ireland, basically there was a lending program of 85 billion. How was this bill footed? Basically 22.5 by the IMF, 22.5 by the EFSM, 12.9 EFSM. These are part of the new EU architecture to avert a sovereign crisis. So basically, these two are part of the new EU architecture to avert a crisis, and now they have been replaced by a new creature of public international law, which is the ESM. Also bilateral loans, this is output lending from the UK, Denmark and Sweden. And basically this is all lending school where mainly it is financial assistance in exchange of conditionality. Basically the three main pillars here are strengthening and a comprehensive overhaul of the banking system, ambitious fiscal adjustment, and growth enhancing reforms. Portugal, something very similar, 78 billion, IMF, EFSM, EFSF, and basically a 3-year program based on fiscal adjustment, growth and competitive enhancing, and measures to ensure a balanced and orderly deleveraging. Greece's second bailout program, or second financial assistance program. Why I'm not talking about the first one? The first one was quite informal. It was an ad hoc, multi-party syndicated lending. At that time, there was no kind of set institution to deal or to provide financial assistance. And basically what they did, all the Euro area member states were pulled together and they provide assistance. Now, when the second time came, basically there were already the EFSF and EFSM were already in place, and basically they put this to try to get the debt to GDP ratio by 2020 to 120.5%. That was the original plan, because then this was revised. Basically, Euro area member states plus IMF committed an undisbursed amount for the first program. And then the first program was bilateral loans, second program financed mainly by EFSF. Financial assistance was 164.5 billion until the end of 2014. And then the release on disbursement will be based on observance of quantitative performance. On top of that, they were required the implementation of the PSI to enhance the program. The PSI managed to achieve face value reduction of 110. However, the assistance was of 130. So basically, I'm not sure. I understand what was the rationale behind this, but basically I'm not sure whether it was that positive for Greek citizens, in the sense that now most of the debt is all official. Official means there's no formal haircut possible. Of course, we will have the rolling over or interest reduction, which is a reduction in net present value of the loan, so that can be seen as a haircut on the official sector lending. But again, if you ask me, having to repay 300 billion, I see that quite difficult, if not almost impossible. Of course, this will be accompanied by the strengthening and monitoring of preconditions established in the first financial assistance program. Spain was slightly different, and here we move back into the financial crisis. Basically, Spain was to recapitalize the Spanish banking sector and to regain market confidence in Spain. Mainly, it was 100 billion agreed to bail out the banking sector, and basically all the conditionality had to do with the banking sector. Basically, the diagnostic as regards capital needs of banks, segregation of impaired assets from the balance sheet of banks, recapitalization and restructuring of viable banks, applied to individual financial institutions targeting the financial sector. So as you can see, all the conditionality on these 100 billion that were lent to Spain were mainly to do with the banking sector. This is how it was structured, and this is more of a legal nature. Basically, at that time, ESM was not in place yet, so EFSF was lending. Originally, they were saying that they were going to recapitalize the banks. So basically, the lending will go directly to the bank. The problem is that EU taxpayers will be affected. Why? Because basically then the banks are the ones that are supposed to be paying back EFSF. That's why they decided we are going to lend the government of Spain. The government of Spain is going to lend to the fraud, and the fraud, which is the reorganization body or banks in charge of the reorganization, was going to lend the banks. Banks repay fraud, fraud repays the government repays EFSF. Then, since EFSF in theory was supposed to cease to exist, they would be replaced by ESM. The reality is that they acknowledge that ESM did not have big pockets sufficient to deal with crisis. That's why now there's an overlap that the life of ESM has been extended. ESM came to birth earlier, and now they're overlapping. In theory, EFSF is going to die, but that's still to be seen. And then Cyprus. Here you can see an actual academic doing field research. What happened in Cyprus was something which was, from an academic point of view, and please don't quote me out of context, was fascinating. It's something that I'm still puzzled, I'm trying to understand. The plan was, yes, inflict pain on depositors, apply a haircut on protected depositors. Of course, nobody now feels proud of it, nobody will acknowledge it, but basically, my understanding based on different conversations with different officials and policymakers is that, yes, it was the EU and the IMF who came forward with a proposal of inflicting pain on protected depositors. You can argue whether this is reasonable or not, but my main concern is that they affected one of the fundamentals that I'm going to explain now. Basically, 10 billion, again, here there were two troubled banking entities, and this is a link to why are you talking about adjustment programs when you have to talk about the banking union. What I'm doing is I'm trying to highlight the problems to see where we are going. Basically, in Cyprus, of course, there's a typical conditionality that applies similar to Portugal, Ireland and Greece, but also here has the strong element of the banking sector, like in the case of Spain. And basically, I think that there are two lessons learned from the case of Cyprus. The first one is a popular belief that God created the Cypriots for Greeks to feel better. That was mainly after what has just happened with the Greek crisis. And the second one is, if we look at what has been happening in Cyprus, basically, it's not that they kill completely deposit insurance, but they have seriously undermined deposit insurance. They have seriously undermined deposit insurance because the reality that now protected depositors fear that they might not be protected anymore. When they were trying to implement the secret conditionality, basically saying, okay, a 40% haircut on protected depositors, what happened there was that the finance minister of Spain had to came forward and said, no guys, we respect the sanctity of depositors. But the reality that they have undermined this. Now there's a general disbelief of what will happen. But what we are experiencing is that basically the whole Western Hemisphere is waking up from a macroeconomic party, and basically they're experiencing a hangover. And unfortunately it hurts, and it will hurt for a while. This is from the movie The Hangover. If you haven't watched it, I strongly encourage it. It's a saga. There are 3 parts now. And you will understand why it's said that a hangover is painful. Some of you might be experiencing it today after yesterday's dinner, but basically now the whole remedy so far has been working on austerity. And basically here there are 3 different quotes on austerity. Basically, it used to be just called budget consolidation or solid economizing. Now it's called austerity, which sounds as if some sort of enemy is coming after us. There are quotes from Angela Merkel in April 2013. These are 3 quotes from the same week. A policy to be successful not only has to be properly designed, it has to have the minimum of political and social support. Jose Manuel Barroso, April 2013. Actually, not only the same week, the same day. And again, on the same day, Enrico Letta, Italian Prime Minister, Europe's policy of austerity is no longer sufficient. So clearly what you are seeing here are 3 different views on austerity. And basically this is showcasing the 3 different, not the 3 different views, but basically different shades of the same problem at the EU level. And what you are looking here now is that we have been dealing with austerity. We have kicking the can down the road, delaying tackling the problem. In the process, okay, we will have austerity, and this will be there by means of austerity. Another way of austerity is looking at the menu of what we had last night. Basically, one picture is worth 1,000 words. Basically, I think that this is another way of very positive austerity. And guys, don't get me wrong, I'm not mocking the dinner. What I'm doing is basically, thanks to the dinner, today I didn't have breakfast. And probably next week I will go on a diet. So basically this is voluntarily austerity. It has even a greater impact. I am doing myself. It's not that the government put me through austerity. But basically, the bottom line here is that, and here I'm just wrapping up because I'm conscious about the time, basically is sovereignty is a source of all evils. Basically, we had this kind of crisis. We were not ready at the EU level. Why? Because each time that we need to take or adopt something which can help is to tackle something like a crisis, like how to deal with the banking sector, and that's why we are linking this to the banking union, is that, guys, the problem is sovereignty. When we need to give up our rights and share our rights with our partners that I'm not sure how much we trust them, because each one of them has its own political agenda, each one of them has its own interest, each one of them wants to develop a particular industry, each one of them needs, for example, to be re-elected. It was Sarkozy last year, and Obama last year, it's Merkel this year. So each one has its own agenda, and each one is pushing whatever their voters want to push. Some of them want more austerity, some of them want less austerity, some of them want more tax discipline. I can go forever, but the message, what I'm trying to convey here is that whenever we are moving into some type of solution to deal or to tackle the problem, then what we are faced with is that we clash against this word, which is sovereignty. And sovereignty is not a minor thing, and that's what is kind of right now stopping us or preventing us from going forward and moving to a full banking union. And basically, just to wrap up and link it with the original title of the presentation, we have an EMU with a strong E but a weak U. Basically, we have an economic union. Not we all, but most of us have the euro. Actually, most of you have the euro, because I'm based in the UK. Most of you have the euro, but basically, the union is weak. It's weak in institutions. The something that has been highlighted by the crisis is something in which we need to start working towards. But the reality is that, again, each time that we want or we are in the process of making substantial progress, we clash against sovereignty. Thank you, Chairman.
Thank you. Because Rodrigo has touched on several issues, are there any questions before we move to the next speaker? Okay.
I cannot believe I've been that clear. It's early. It might be still early.
Okay, we'll wrap up at the end. Professor Caldeira, Cabral, please.
Good morning to all. Thank you very much for the invitation, first of all. I was not sure about, because the title had so many approaches, to which approach to follow. So I followed them all, so I'm going to jump a lot of, I was expecting to see what points, so I think a lot of the points that I have were already covered, so I'll try to jump a bit of that. One of them is the Euro, the unfinished building, and it's about the architecture or the unfinished works that were done when the Euro was built. I think a lot of these issues were already addressed. The importance of a banking union, and since it was also growth in the title, I would like to address this idea of the limits of export-led growth, which I think it's an interesting issue here, because the idea that the southern European countries would have to have export-led growth because the other options of consumption or government Keynesianist kind of politics are not available. So this is the one available, but there are strong limits which are linked to the competitiveness and to the size of the export sector that I'll try to address. Okay, the euro as an unfinished building, the banking union that doesn't exist and we expect that will exist sooner better than later, the no lender of last resort, the debt solidarity mechanisms that didn't exist. The euro was mostly a political decision speeded up by the enlargement agenda, left unfinished for political reasons. This idea is that Of course, were economic gains, and a lot of them were discussed, but the speed up to the euro and the way a lot of countries gone into the euro had a lot to do with political internal agendas, and the way it was left unfinished was to, well, if we have to do this and we are going to do this fast and before the enlargement and all these things that were already coming in the end, well, if there's no agreement about certain points, we'll discuss them later, and they were never discussed until the crisis, or at least no solution was found. But on the other hand, the European Union had a lot of things like this in the past, that the common market had parts that had to be improved, like competition law has been improving, and a lot of these things, what was done was like, there was this big jump forward, and then there was some trust that things would be solved because there would be incentives for that to happen. And in the case of the euro, when the problems came, the nationalist view, well, not in with the crisis, in the first response to the crisis was a coordinated one, but then with the nationalistic view and the sovereign crisis, the division between countries didn't allow them to advance or to get solutions during the crisis when most was demanded for them. The slow pace, the divisions about small issues, and even now the banking union is, we are all waiting for elections and things like this. And this is like, the point was already made, this is an important, how can we trust our partners if European policy now is dependent on elections, on changes in government, and this is like goes a bit against what was said yesterday about politicization, and politicization of European issues in a way is a good thing, but on the other hand, European issues in a way were not very politicized, but countries would be quite responsible when dealing with them. They wouldn't deal with them with the kind of demagogical political agenda. And in some countries, the demagogic political agenda, when the crisis started, marked a lot the response and marked a lot the limitations that these countries now have to change some policies, because they managed to convince their electorates that the problem was really southern countries' wrongdoing, not working enough, and all these things. And it's quite difficult now to go back and say, well, it's this, but it's a lot of institutional kind of problems, because it's a very difficult thing to explain in a soundbite. Problems before the crisis, the average growth rate, I have here for Portugal, it was a really, really slow growth rate. The last decade, but when we compare the 90s with the 2000s, the growth declined almost in every country. The exceptions there are Greece and Spain, where the decline was, well, in Greece was really, really small, the decline, but we know now that this was not sustainable growth. It was growth based on indebtedness and on construction and on either public or private indebtedness and non-sustainable growth. In Portugal, as you can see, and in Italy as well, the decline in growth went from a very good growth rate of 3% in real terms to a lower than 1%, 0.5%. And this was the first thing that had a strong impact in the public finances before the crisis. The public expenditure in the decade of 2000 grew at half the rate at the previous decade, and the growth was mostly done in parts that were decided earlier, like social security, rights that were attributed in the 90s that had the path of going on and were very difficult to change. So, okay, without the crisis, the adjustment would have been much smoother, but even without the crisis, the adjustment would have to be done. I always like to put these two things because these two countries speak the same language, but apparently when one is growing, the other one is not growing. It's Brazil and Portugal. And it's a strange thing because it means that when Brazil is having the right policies, Portugal is always having the bad policies. It's a strange thing if we are thinking about policies that determine growth, which is... And the thing is that if you look at I'm sorry, this is in Portuguese, it was adapted, but it's the difference between the GDP of Brazil and Portugal. So when it is in red, it means that Brazil is growing less than Portugal, and you can see that there are periods where Portugal, the difference was like 5 points, that Portugal was growing more than Brazil. And the other things here, this is coffee, agriculture, materials, sugar, and oil. And what you see is that the cycles where Brazil is growing less than Portugal is always when the commodities are coming down. Primary commodities are coming down. And when they are coming up, Brazil grows more than Portugal. And of course, in the last decade, commodities came up a lot, and this had a huge impact in Portugal, because it increases a lot our expenditure with imports. So a lot of our deficit, non-correction during the last decade, had to do a lot with the increased import prices, and not with any other thing than that. Of course, increased import prices without adjustment, the necessary adjustment in consumption. But this was a main effect. The other main effect that I would address a bit later was the effect of the Chinese entering to the European Union, or put it in another way, the opening of European Union to Chinese imports, which affected especially Portugal. But also the enlargement of the European Union affected negatively most of the southern European countries. And here we have some asymmetric shocks. Nobody talks about asymmetric shocks these days. It's such an academic issue some years ago. And, but there were some asymmetric shocks in this last decade that sometimes we forget. Asia uprising and China getting into the WTO, the opening of the internal market to the Chinese products had a huge impact on South European countries, in particular in Portugal, because Portugal main exports were still in the end of the 1990s based on labor-intensive products that compete directly with the Chinese imports in the European markets. So Portugal had a protected market where it was the low-labor country, and a lot of lower wage countries came in to the market, and the market opened itself to imports from really low-wage countries. So in that sense, it was quite negative. Enlargement, increase in food prices. Of course, the recent crisis also had asymmetric shocks to different countries, but it's more complex than that. The European policy didn't help as well. There was a decrease in barriers on the entry of labor-intensive products from low-wage countries, which was affected more the South than any other countries. But there was less of a decrease in agricultural goods, where the South is mostly an importer. This has to do with very complex things, but the thing is that we always hear the European Commission talking about liberalizing markets, and then the market ruled by the European Union is the one that is more complex and more full of rules and strange things. And come on, they come and preach something, can they not do this? And I think there was a good opportunity now to revise the European Common Agriculture Policy in a moment where agriculture prices are high. The adjustment would be easier in this time than if they came down again, which it's not a prediction at all. Regulations made it more difficult for EU firms to compete with extra EU countries. And this is especially the case for small and medium enterprises and so on. And there has been more and more of these. And of course, you can say that some of these regulations, if you are doing high-tech products in Germany or in Portugal, we do them as well. But if you still have a lot of your industry in less technological sectors, environment regulations, a lot of these regulations that are not wrong would put a cost tag on you, and you are competing in the internal market with Chinese products that get into the European Union that are not being produced with the same standards. Not the security standards, not the environment standards, and it's just going there and checking it in local, and it's quite easy to check that it's not the case. The Eurozone imbalances, what we have here, I'm sorry again that the names are in Portugal, but it's Germany and Holland up there, and it's the Southern European countries, and Ireland in green. But the imbalance in the current account lasted for a long time. With these current account deficits, you can see that a common monetary policy was not possible, or was not going to suit anyone, because of course the countries that are above the right policy would be a valuation. The countries that are below with the current account deficit, the correct policy would be a devaluation. This competitive issue lasted for a long time, and the euro had a really, really strong appreciation in this period. And sometimes people say, well, but since these countries are exporting mostly to the Eurozone, they are not really affected by devaluation of the euro. This is completely false. For the case of Portugal, it's completely false. Portugal is competing in the Eurozone with a lot of products that come from non-Euro countries, like the Eastern countries that are in the European Union, but some of them are not in the Euro. And a lot of the Asian competition comes with currencies that are not Euro, of course. And this strong appreciation didn't help the South at all, and it means that the common monetary policy followed the right policy for some countries and not for the others. And when we are talking about institutions, we have to talk also about the management of institutions. Well, the banking union, a lot of the things that I had to say here were already said, so I'm going to pass, not to surpass too much, I'm going to pass for the growth issue. The first idea that I have here, and very simple, is that the United States and the Eurozone had a growth path quite similar until the reaction to the crisis. The austerity choice had a huge impact in growth. And the costs of these, if you put that red line and put it following the blue line, are several times the indebtedness of Portugal, Greece put together, or Ireland. So the choice had a lot of costs. Of course, the costs were, in terms of losing GDP, were all for the Southern European countries. That is what we believe, unless we look at the data and see that Germany was growing faster in the outcome of the crisis, because when compared with Japan and the United States, it has a very strong exporting base. And it's not growing faster than these countries. It's almost not growing in the last 2 years. And Holland or the Netherlands is not here, but it has a negative growth. France had a negative growth. So even core countries were affected. They were not affected with minus 7% of GDP like Greece or minus 3% like Portugal, but they were affected, and they were strongly affected. Losing 2 or 3% of growth for 2 or 3 years, it's a lot of GDP lost. And in the Southern European countries, there's a lot of evidence that this was not short-term GDP. It was long-term GDP that was lost as well. Convergence in the euro area, what you have here is like growth compared with GDP per capita. And of course, countries with lower GDP had higher growth, so there was convergence between 2001 and 2007. And in the last year since the crisis, 7 out of 10 of the countries with lower GDP per capita in the Eurozone are with negative growth. So, and you could see a positive line here, which is not positive at all. It means that divergence is there already for the past 5 years, and probably is going to be there in the next 5 years. This idea of the change in the debt to GDP ratio, sustainability strategies, either you decrease the deficit, which was the only strategy, or you have to increase the growth rate. The best thing to do is to do a bit of both, and of course a more balanced mixed in the European Union with countries that didn't have an indebtedness problem putting less austerity, and countries which have more problems cutting their expenses. So working on this side of the equation, but getting some release in the part of growth would be a better strategy. But the part missing is trust, decreasing the interest rate. When the European Union lost trust, it lost this strong part of the equation. A part of the problem of unsustainability of Portugal or Greece is that we are paying interest rates that are very high. If we had the interest rates of Germany or of Holland, probably even with the level of indebtedness, which is not positive at all, the countries would be sustainable. What happened with this crisis was the point of no return, where the interest rates start climbing, was put back to the left, and was put back because the countries have less instruments, and because it was quite clear from the beginning of the Greek crisis that solidarity was not going to be in place. Export-led growth, just 2 minutes for this. What we have here is export growth, and what you see here is that in the last 8 years, so from 2005 to 2013, Portugal had a very good growth in exports, and Spain as well. Greece and Cyprus didn't have such a good growth in exports. So you could say that at least some countries could go the export-led growth kind of situation. But the thing is that Portugal was having a very good export growth even before the crisis, and that didn't help that much. But it helped a bit in the austerity measures. Our GDP didn't fall 7% like the Greek, mostly because our exports had a better behavior. And so it fell only 3%, which is already too much if you are trying to consolidate your public accounts. The strong correction of the current account deficit, it was really, really strong in a lot of these countries. You have 18 countries that had the current account deficit in the European Union, and of these 9 are now in surplus. Portugal is one of them, but Greece was the country that had the biggest adjustment in the current account, but it had a worst position for a start. But the thing is that if you look at the left side of this graph, you see that a lot of the countries that already had a current account surplus increased the surplus. And this is like, okay, the countries in the right are doing their part to solve the problem. The countries in the left are not doing their part, are just doing the opposite of what they should do to solve the imbalances within the Eurozone. What I have here is exports in GDP, and this is like the limits of export-led growth. Greece, Portugal have a very low export pace. This is not a positive thing, it's a bad thing that these countries have. The Greek one is lower than the Portuguese, and this doesn't compare with Ireland. So this is the reason why Ireland will have talk about export-led growth in Ireland with the export base of Ireland is quite possible. Talk about export-led growth in Portugal or Ireland or Greece, it's possible, but with very high interest rates is not going to solve the debt GDP ratio, not going to stabilize. It's not going to be enough to stabilize. So there has to be more than this, and this is a strong problem. What I have here is debt in GDP and exports in GDP, and of course you can see Greece, Italy and Portugal. In Italy this is not as much as a problem, because Italy has a lot of finances its own debt, so it has much bigger saving rates than Portugal or Greece. And you see that in Ireland, the export to GDP and the debt to GDP ratio are quite matched. And then you have other countries there with different degrees of the problem. But the combination of high debt to GDP ratio and low export to GDP ratio, it's a problem. In Portugal, it has increased. In Greece as well. In Portugal, it has increased mostly because exports have been increasing quite well. But even what I have here is the interest payments divided by exports. Nobody is really looking at this anymore. It used to be a very important ratio when you look to South American countries. It's quite sad that now we are looking at European countries with the same ratio. But the thing is that interest payments by the government only, we are not putting here the private ones, would go for up to almost 20% of the Greek exports. And since these interest payments really go abroad, it is a huge burden and a very difficult one to digest. In Portugal, they are 11%, but still is a lot. This is especially because they go abroad, so they have a very negative effect on growth. Portugal had unitary labor costs that went down a lot in the last years, but the export growth of Portugal didn't. It's still growing, but in the last years it has declined the rate of growth. Although this behavior of the unit labor costs, so decreasing the wages will get us to the solution of fast and faster growing exports. It didn't happen in Portugal. The wage decrease, everything happened as it should. The crisis brought a decrease in wages, but not an increase in the rate of growth of exports. This is mainly because a lot of exports go to the European market, which is not growing. But it's not only that. Its investment has been down for more than 5 years, and with low investment it's very difficult. It was quite easy to recover the levels of exports from before the crisis, but it's difficult to maintain that. I'll go to the conclusions, and I'm sorry that I passed a bit my time. Export-led growth has to be the way forward for the southern European countries, but these countries have a low export base, are concentrated in the low growth market. They concentrate their exports in a market that is not growing, which is the EU, and are exposed to competition from low wage countries, which means that it's quite difficult for them to do big jumps in the export base. There's been some miracles in Portugal, and I know that in Greece as well, firms managing to export more, even in this competitive setting, but it's quite difficult. In cases like Cyprus that was quoted here, entire sectors were put off of export, like the financial sector of Cyprus was an important sector in the economy, and with these decisions it was completely erased as a possibility of growth. Cyprus is not going to grow with financial services or with a lot of other services that would require confidence in the country. Okay. The Eurozone have less instruments to react to the crisis, so they need support mechanisms. A banking union might help, but it's also needed central automatic stabilizers, a Marshall Plan or something of the kind to boost investment. Otherwise, the waiting just for the export-led growth is not going to be enough, and the indebtedness problem is going to stay here, or the sovereign debt is going to stay here, and debt mutualization mechanisms that can lower the interest rates that these countries face by giving confidence. I'm sorry that I surpassed a bit my time. Thank you very much.
Are there any questions for Manuel? Adoni.
Discussing with this idea of the master plan, this potential criticism across what John Kokkoris said yesterday. I think that in the south, even the countries in the south cannot absorb already available funds because of administrative constraints, or they have over-invested in infrastructure, in the case probably in Portugal with the highway system. In the case of Greece, a greater flow of EU transfers, again, would refocus the country into wrong directions, to again reanimate collusion between the business sector and the government. Yeah, so I don't know whether we would like, I think we need to discuss this whole notion of the master plan. My preference would be to restore commercial lending at competitive interest rates. I think this is where we need to focus. And also to boost support to the unemployed, which is an important demand-led measure as well. But about the whole notion of the master plan is a bit dubious from my perspective. maybe we'll be interesting to discuss this a little bit more.
This is a big question, which comes to my mind wherever I hear about boosting investment. Part of the problem in some countries, Greece for instance, is the quality of the investment that happened earlier. So this is linked also with entrepreneurship, but it's also linked with a kind of network of invisible relationship between politicians, the bureaucracy, and private interests. And also part of the problem of Greece is the very weak, relative weakness of the sector of tradables vis-à-vis the sector of intradables, the non-tradables, that is, activities that are not exposed to competition. So if we sort of go fast forward in increasing investment, I have the feeling that both these weaknesses, the quality of investment due to clientelistic networks and the inertia of the economy in favor of non-tradables will lead us very, very soon in a similar situation of lack of competitiveness, unsustainability, and so on and so forth. How would you ask?
I really agree with your concerns. I'm stressing them in Portugal as well. I'm involved in the negotiation of the 2020 program, the program to allocation of the funds. And it's true that the massive investment in infrastructure, at least in Portugal, I think in Greece there would be some room for that. But in Portugal, we don't really need that. What we are trying to focus on the funds, the European funds that will come, is to put them in mostly in the competitive funds and in the tradable sector. To do that, we have to fight a lot with the European rules, because saying that the funds must go to exporting firms, well, don't try to put that in any document. But sectors exposed to international competition may be accepted, or tradables, or whatever, and this is what we are trying to do. It's like to focus the support on investment in the tradable sectors, and this is like what I think should be done. And this should be done not with public funds, and of course it should be done with transparency, of course, but it should be done with loans. One of the big changes that we are trying to make there is that the money that goes to the firms, a big part of it has to be reimbursed. So money for investments in innovation, in technology, in machinery or whatever, they have to be, of course they will be at either with no interest rate or with a low interest rate, but they have to be given, it's not like they are given away, so a bit like a loan. Low interest rate loan. And this means that it's there to avoid the idea that there were some investments like this, that if the money comes at no cost, well, we will accept it and we will do these investments either they are good or not. And so we are trying to focus on the idea of quality of the investment. But the truth is that in Portugal, but in all the southern countries, investment have been coming down for 5 years, 6 years, in some countries even more. And this is not sustainable with the recovery. In Portugal, our level of investment is about 11-12% of the GDP. This is not sustainable with the recovery. So we are losing production capability, and we are losing this production capability in a lot of tradables as well. And the signals you see there of low investment in these sectors, and the signals you see of employment not increasing in these sectors, it means that the adjustment is not happening. The adjustment of the countries that were in debt should be less consumption and more production. And the less consumption, we are doing that quite fiercely. The part of more production, we are not doing that, and I would argue that we are doing exactly the opposite. We are destroying the production capability in the labor market with the lower investment rates that we have now. This is constrain the production capability, and it's going to condemn us to a much more difficult adjustment path, or even to an impossible adjustment path. So if nothing is done here, and nothing was done here in the last years, I think we are going to not go for the sustainable path. Thank you.
Thank you for that. Let us continue with the last speaker, Professor Kokkoris, who specializes also on competition issues, and then we will open the panel for discussion.
Thank you, Mr. Chairman. That's a bit too high for me. I'm not as tall as the chairman. Let me try to put my slides here. Let me just try without. Now, what I will be talking about now touches upon both Rodrigo's last comment about the weak institutions we have in Europe, and also, as soon as Manuel now in his last comment was talking about if we cannot put in a document that we will give funds to any particular type of company. So these two, in a nutshell, is what I'm going to talk about. Because of timing, I will not present all of it, because there are 30 long slides there. So I'm going to just touch on a few slides just to give the main points out. I will start from Rodrigo's point. There's an issue with weak institutions. Yes, that was an issue. In the crisis, we did have an issue. We did not have the right institutions to actually tackle when the mess hit the fan. I don't want to use the other word. I apologize. So, what happened then? On the one hand, we have the single resolution mechanism, which came in as an attempt to try and save banks. Any banks or any other institutions which are ailing or they're in deep financial trouble. That's a great move, a great initiative to allow, to streamline how in the future we're going to actually react if this happens again. However, that part, that law, goes against state aid, which is also mentioned in the resolution itself. On the one hand, yes, you have a resolution which will be giving funds to any entity in financial difficulties, in the financial sector, of course. But the Commission will participate to perform the specific tasks in relation to state aid. So you have a trade-off here. I can give money out to actually save the bank. On the other hand, this can be legal state aid, so I need to make sure how I do it. And what I will be touching upon today is where does this balance leave us? Where does this balance leave us? And should the SRM be treated in an inferior way to state aids or not? I'm not an EU lawyer. If you have EU lawyers here, I'm sure they will correct me. But state aid is part of the Treaty for the Functioning of the European Union, which means, as I understand the law, and again I don't understand it very well, this is the top law in the European Union. Nothing can be overlapped. That's state aid. Then you have a new resolution mechanism, which apparently wants countries to do stuff which are illegal on the basis of this treaty that we have, and it's a top law in Europe. Very briefly, what is state aid? That's from the Treaty for the Functioning of the European Union. Aid, which entails a financial advantage from state resources, selective advantage favoring certain undertakings, distortion of competition, effect on trade. I don't want to bore you with this, but what I want to do, as you can see, that's a long presentation here, is go here. And I started asking myself, well, I read the resolution, and I was trying to figure out, in reality, when this has to be used, how are they going to make sense of it? How are they going in practice to make this work? And I started asking myself a question. The question actually, sorry, I actually ran ahead of myself. Does SRM borrow state aid or not? That is from the resolution itself. The board considers that the resolution measures could constitute state aid. And then, which I invite the participating member states to act. So, the resolution itself says, what I am here to do, make state aid, I cannot do anything about it, it's the member states which have to actually notify the Commission whether the restructuring plan they want to put forward, whether that will be approved or not. Why? To give you an example of a mess in UK at the peak of the crisis, September 2007, 17th of September, I think it was a Monday, Lehman Brothers falls apart. That, we all know, I don't want to go into the details, that leads to a number of reactions from many governments. In the UK, one of them being Lloyds Banking Group, one of the top 4 banks in the UK, had to be inverted commas, had to buy, or was advised, to put it differently, to buy Kiriakos Bank of. Why? Because HBOS would go bankrupt and then we would have a system crisis. What happened? The acquisition went ahead. How? UK government put in the funds. Government puts in the funds, the European Commission comes a few months later, that's it as they did. You cannot be doing this. So, what happened in the end? Lloyds used funds to buy H-Force to save the banking system, and a few months later, Lloyds had to divest 600 branches and reduce the balance sheet of £1.81 billion as a result of the exposed intervention of the European Commission. So it has happened, we have made mistakes, and the whole point behind this new initiative now is to make sure we do not make the same mistakes again. Just to give some numbers, how much aid are we talking about? How much is this money are we giving? 1992, 2011 here, total state aid except railways. As a percentage of GDP, we have here, actually I cannot see very well here, here. You see exactly when periods were at peak and where we're actually now. 2008 to 2011, different types of measures, all of which were used by 27 member states in their reaction to the crisis. I wish you could see the total number down there, but you can't. But I will give it to you. 2008 to 11, 1.615 billion. 1.6 trillion euros in 3 years. And if you think this is enough, check this out, which again you cannot. 2008-2012, 5.086 billion euros. That was the amount of state aid that was granted by governments, 27 member states, to different institutions. But again, that covers a number of different measures. Let's try to see how would this new resolution, new initiative to ensure the proper resolution of banking institutions, would it have application? This is, again, go back, these are the cases in a few member states of banking institutions which had to be restructured, liquidated. All of these cases right now fall under SRF. All of these cases were state-based. All of these had to be approved. At the peak of the crisis, they were approved exposed, but all of these would have to be approved. So there is a clear, huge overlap between these two policies. The aid to treat on the one hand, which is the state aid, and this new initiative to actually do better next time in our reaction to the crisis. Again, forget about that, but this is where we start becoming interested. Now, the resolution itself and all the crisis measures that the Commission has issued in the area of state aid, they have actually used, and I see if I can make it square, yes, this really interesting term there, burden sharing. Now, of course, from a competition law perspective, burden sharing means nothing. Burden sharing, you can apply in different contexts and would mean a completely different thing. So the question is, how does the resolution itself apply this concept to exactly how an institution will be actually saved or will be funded out of its mess? And a few pointers there. Burden sharing will entail, after losses are first absorbed by equity, contributions by hybrid capital holders and subordinate debt holders. They have to contribute to reduce the capital shortfall, and of course, Commission will not require senior debt holders to actually put their hand in the pocket. So that is how the balance will be stricken between burden sharing that needs to be there, which will satisfy the Commission that a particular plan will not constitute illegal state aid. A member state will have to notify a plan to the Commission. However, we are pragmatic. We know that life does not run at the pace of the Commission or any other authority. We have to be realistic, which means, in exceptional circumstances, yes, as it happened in the past, what we will do is we will approve it and then expose it, we will come to assess it and impose measures. Two different types of aid that can be given, two different approaches on whether the plan has to be notified by the member state or not. Some flexibility here in the resolution and in the communications for the banking sector of the state aid leg of the European Commission on exactly what types of fund aid can be given with or without. Again, number of conditions for liquidation aid. This is too much jargon. The whole point is what the Commission is trying to do with its communications on state aid, and what the resolution is trying not to do is to ensure that any aid which will be given will not create more harm than the benefit will bring. And why would a state aid create more harm? And that is where we try to wear a European Union lawyer's hat, and all European Union members, we have to respect the treaty, so we have to respect this. State aid creates problems because it's too competition. Clear moral hazard issue. If somebody knows he will be saved by somebody else's money, if somebody wants to bail me out, I will be happy to invest on these plants here and do a few forward contracts on these plants here, these beautiful white plants. If I know that all of you are going to bail me out. Clear moral hazard. Weaker incentives for non-beneficiaries to compete, unfair share of the burden from certain member states to some other member states, barriers to entry, and fragmentation of the single market, which is the aim of the European Union. So, if you ask me, in reality then, what happens? Initially, I didn't know, is this SRM and that state aid or the other way around? I still don't know, to be honest with you. If I had to advise, I would say we cannot and we should not be treating aid funds which will be given to institutions in this particular context in the financial institutions lightly. Because yes, short term, you have fever, you take paracetamol, if it goes down, excellent, I'm safe, I'm fine. But if you have flu, a day later, you are down again. We cannot be treating with these short-term measures issues which will have much longer-term impact. And any state aid given will have much longer-term impact. So, how the Commission will do it in practice? In reality, I wish I knew. It will not be easy. It will not be easy. Yes, it has some guidelines. Yes, there is a mechanism. Yes, there is more certainty now, because one of the main issues last time was, God, what are we doing now? Nobody knew what to do, how to react. There were different countries reacting in different ways. Now, we know how to react. What we do not know is if this reaction is, first of all, going to be approved or not, because there's somebody else who has to check on it. And secondly, if that reaction is actually going to create more benefit than harm. Thank you.
Thank you, Gianni, very much. Actually, you remind me with the moral hazard problem a quote that I read 2 days ago in Financial Times, that the bankers and investment bankers have been the most highly paid civil servants of the developed countries. And I open now the discussion for questions. Please.
Kokkoris. I think this was quite interesting. But I think that in the simplification there was something overlooked that is quite relevant. There is Article 173b of the treaty, which precisely creates a Cabral and says that aid will be potentially declared compatible with the Commission when it has basically the aim of reducing or remedying a serious disturbance in the economy of the member state. And this was a clause that had never been applied until 2008, and it has been the building stone of all the Commission's intervention in this area. And I think that rightly so, because what the European Commission has been doing is approving 2-year frameworks, 2008-2010, prolonged 2011, 2012, now 2013. But the European Commission is the first one very keen on getting rid of this and bringing 173b back again in order to be used. So I think that everybody is really aware of the concerns you're presenting, and I agree you cannot treat as a short-term measure something that can have very long effects. But on the other way, systemic risk was so biting the butts, they could do nothing else, in my view.
Aris?
For Robert, let's be practical. A couple of issues, because of course we can. Where is Professor already? Yes, of course we can look at it from the legal overlapping mechanism, the procedural lack of coherence, which perhaps we can say we can have some analysis of that. But I think fundamentally, I don't think that the two mechanisms are conflicting or contradictory. There is an issue in terms of substance, as you mentioned, about perhaps the long-term effects, but fundamentally, we see an attempt of a balancing act by the Commission, respecting the principles and priorities set by the European legislature at the top level, which is obviously the treaty, but also, of course, recognizing, as Albert mentioned, the realities. In fact, very similar, perhaps in my view, even more, less subtle reaction was the reaction of the Court of Justice in the Pringle case, where there was a reference, yes, from Ireland, exactly has a constitutional issue about to what extent the bailout of Ireland was essentially violating the no bailout clause of the treaty. And then if you read the findings of the European Court of Justice, it is a fascinating, it's not a balancing act, it's an acrobatic act of the European Court of Justice to, on the one hand, sustain and fulfill its role as the guardian of the treaties and the ultimate authority of interpretation, but essentially reaching the conclusion that the no bailout clause means that you can bail out somebody if you put conditionalities, as if, yes, somebody would just start throwing money away without imposing conditionality. So I think it's a more elegant solution, yes, the attempt by the Commission here to balance the state aid and the other concerns. But I totally agree with you that we have to bear in mind the potential long-term effects of all this.
If you don't mind, there is a question from Gisela, and then from George Pavlatos, and then from Renaud also.
I think I lost the... Okay, all right. Okay? It's working wonderful. Can I return to the concept of the sovereign? Because it really is troubling me. Arguably, when the Bank of England was set up in 1648, the private finances made a deal with the sovereign and said, we give you the money and you give us the trust, and with the trust of the sovereign, the ability to create money. And that deal broke down, arguably, when the Treasury said, we buy Lehman, we buy Lloyd's, Lehman goes to the wall, but we instruct you to buy Lloyd's TSB. And that confusion is something which I think the UK needs to deal with. However, if I then go and look at the ECB and look at all these trouble, who is the new sovereign at the new European level? Who is the authority that creates money? Where is quantitative easing, which, we just chuck in huge amounts of money which the sovereign creates? And I'm trying to work out in this new European Euro world, who is the bearer of the sovereign's trust to create new money? Is that the thing which is yet missing? Or am I missing something?
And another question from George Pagoulatos.
I like the presentation very much. I think that the moral hazard concern has been heavily overrated over this crisis in the last 3 years. It's a very valid concern unless you're facing a breakdown of systemic proportions, in which case you have to rush and extinguish. You have to make sure that you put firewalls. You have to make sure, of course, that you have the precautionary measures to prevent it from happening. And one of these types of measures are, for example, counter-cyclical type regulation that's being proposed with regard to the bonus of the bankers' credit, that they should be deposited in an escrow account for about 10 years. And if the returns continue to be good after 10 years, they can take the money. If they don't, they leave them there. It's very important in such cases to separate private interest and benefit from public good and public interest. What you attempt to do in the bailout is to prevent the systemic disaster that can follow by way of contagion and so forth. Thus, this is justified in terms of general interest. You have to make sure that you separate the private beneficiaries from that. They should not be benefiting. And you can do that via conditionality, and you can do that via serious precautionary regulation of the type that I mentioned. I think under these conditions, the moral hazard concern takes sort of a second rate of significance.
And if we can go to Renaud.
Thank you. I can't resist the temptation of trying to connect today's fascinating discussion with yesterday's discussion, just to say, given the rather delicate dynamic one tries to achieve between different kinds of concerns, different functional needs, will it be any easier the day we will have a too big to fail bank on the verge of collapsing in, say, right-wing, a country governed by a right-wing government, and a left-wing commission that will be called upon to assess whether state aid is compatible with the spirit of the question mark. It's, of course, not okay. At the same time, Gisela rightly reminds us that at the end of the day, resolution, this is a heavily political exercise, and entrusting it to some kind of remote body that is well shielded from public opinions in order to deserve the market's trust is, well, sensible in some respects, but problematic in other respects. So we are really trying to achieve a very difficult balance between different concerns. And in a related spirit, I wanted to ask all three people about their views about, I mean, we talked a lot about the crisis on the one hand and resolution on the other hand, but in between there is banking supervision. And I wanted to have your views on what's being decided, that is to say, why at the end of the day the baby has been entrusted to the European Central Bank, because there were other options, some of which were contemplated, and I certainly remembers that in a distant country, an alternative option was favored that was not listened to. So my question is, how do you view the choice that was made both in, say, in functional and in political terms? Thank you.
And then there is a last question from Catherine, and then the three panelists will answer the question.
Thank you very much for very intriguing questions, and I'm going to just stay my ignorance of economics, so if I say something that's stupid, then please correct me. But I was remembered by Paulo Gao, who gave a talk in my lecture series in Oxford on the future of the EU Europe, in which he also called, and it was in his presentation, and also in Manuel's, of the importance of having an institution that regulates, that is able to govern the EU. Then Manuel's presentation gives us an idea that there's very divergent interests, that some countries may not want to have that at all, because actually what that institution would do would not be very good or very favorable to their own interests. Reading the FT when I came here, Osborne is now going to the Court of Justice, hammering out the banking bonus cap, right? So if you put all these things together, if the only solution for the EMU and the Euro is creating a political institution, which is not in the interest of any member state, or, well, of some member states, to actually put effort in, is the EMU and the Euro going to fail?
And then we have a last question from Dimitri.
Yeah, well, just a comment about Professor Kokkoris' presentation. I found it really interesting as well. But I don't think there's a trade-off between short-term and long-term effects, because effectively the resolution mechanism aims to, as was said before by others, to avert a systemic collapse in the banking sector in a single country. If this was allowed to happen, it would have long-term effects for the national economy of that country. So, plus it would have, as we now know very well, long-term effects on the Eurozone stability as well. So on the one hand, you have long-term effects about the competition from internal markets. On the other hand, really, you have long-term effects as well on the viability of national economies and the Eurozone itself. And since many people talk about the legal issues, but I think in the end it's a political issue, I would venture a projection that the Goliath, David, their picture, the Esser and the Goliath, because at the end of the day, national politics will trump in the long term, I think, if competition reputations and exists. Thanks.
And sorry, but the last question from my side. On 2014-2015, ECB has created a new acronym called AQR, Asset Quality Review. And my question to the panelists is, they are going to supervise the biggest systemic 120 banks in Europe. Does this mean that if they find a problem, let's say in a big bank in Greece, they will have the right to shut the bank down? And Rodrigo, if you can start with the...
Thank you, Mr. Chairman. I think I've been extremely lucky. I think there was only one question that was slightly touching upon my topic, which is capitalism on the important of institutions, which I believe in institutions, but the reality is I'm not that much convinced about the need to, in sovereign arena and bailout risk, etc., having at the EU level today the ESM and join with the EFSF, in the sense that they provide a solution, but the reality is at the end of the day, it works like a duck, it's yellow covering feathers. Why do we call it ESM instead of just calling IMF? Because the IMF is involved in all the different steps. The IMF is the one that negotiates conditionality, the IMF oversees, the IMF does the DSA, the sustainability analysis. The IMF puts money. The only explanation is a political one. Basically, after war, basically why the IMF has to come and to the EU and say what we are supposed to do, which in the end ended up happening. Plus the fact that some of the donors of the IMF were not that happy about lending to developed countries that have their own resources. But I would have created a sub-institution within the IMF rather than creating a whole new institution of public international law. Having said that, it's kind of a reflection and I would not put it as a question to Kokkoris, but I would like to see his view when he answers. But basically, I feel like a general sense that in exceptional times we can resort to exceptional measures. And particularly Albert and Alice were quite pushing this, and then from that side getting the same issue again and again. What I can tell you is, I am originally from Argentina. I have outlived a couple of crises, and basically I have realized that the exception becomes the norm, and that is extremely, extremely dangerous, particularly when you start undermining fundamental rights. That's something that has been seen in Europe. If you ask me, I will never explain that in Europe. Basically, the disrespect of the sanctity of contracts, that's what happened in Greece with the TSI. Due to a legal technicality, they undermine the sanctity of private contracts. We see in Cyprus when there was a very serious attempt on killing completely deposit insurance. And the reality with this, what you're doing is you're attacking predictability, accountability, certainty, the respect of the rule of law. I'm scared to death, as you are, with systemic crisis. But the reality is that by creating moral hazard, aren't we contributing to a bigger systemic crisis? And the reality is that what we need to do is work more on prevention rather than cure. Because basically, where is supervision? What has happened with supervision? What has happened with proactive actions? Preemptive measures rather than, okay, when it happens, we need to deal with it. Yeah, but that's, for me, it's too late. It's too late. We need to be one step ahead. And basically, the reality is that at the end of the day, with this new resolution mechanism, I find inspiration in Spider-Man, because basically, with greater powers, we have greater responsibility. And that greater responsibility is preventing rather than see how to deal with it or how to cure it. And I think it was Dimitris who was referring to this is a political issue rather than a legal one. But on that, I slightly disagree in the sense that if it's a legal problem, it will turn up being a political issue. And once it becomes a political issue, sometimes we end up undermining the legal aspect of it. And basically, at the end of the day, that's where the certainty, predictability, and accountability comes into the picture. So basically, it's a kind of a yin and yang. It's balancing two interests. But I think that in the end, politicians come and go, but the law or the legal principles remain. You can tell me, yes, we amend the laws and the legal principles go. And that's what I'm presently fearing, and what we were discussing last night about amending the treaties on a regular basis. Basically, what we are doing is we are undermining the institutions that we're referring to, basically the treaty. Now, a treaty is like, I would not say it's like toilet paper, but it's something that we can amend on a yearly basis.
Sorry, Vasily.
Just if I may, a reaction on that, and just to try to bridge the gap between lawyers and economists here. We lawyers are doing something very simple. We say, yes, there is a law, you cannot, for instance, provide savings, etc. There is a rationale behind that. You cannot bail out the bank, but there is an exception if this is good for public purposes. Okay, if this will help us protect general interest. My question to the economist is, I don't have the tools as a lawyer especially in so complex situations, to identify what is general interest. Is it better to give money to the bank, to take taxpayers' money and give it to the bank, because then pensions will be rescued? Or it is safe, or it is better if I let the bank to collapse, because then they will be punished for being non-diligent enough. And this gives a good example for the future. And my question to the economist is, because you said this is public interest, let's protect public interest. Is there any math behind that, or where is the place of ideology in that? Is there a proof in that? Because if there is economic proof, scientific proof, then for me as a lawyer, my task is very easy. You go to a constitutional court, you go before the Court of Justice of the European Union, and the answer is simple. Yes, there can be an exception, we can limit the prohibition. Why? To protect the society, to protect common interest. Yes, but what is common interest? This is what I don't know as a lawyer. Thank you very much.
And if Ioannis can also reply to the questions. And apologies.
Something very briefly on that. We are overestimating the role of lawyers, politicians, and economists.
But we are better than economists.
Not as good as politicians.
Who are we?
And Yanni and Manuel, I apologize, but we try to stick to the timetable, and this is an Anglo-Saxon timetable, not a Greek one. So if you can reply within 2 minutes to the questions, and then you can.
Apologies.
I need another conference to reply to all these questions. I'll try to just a few main thoughts. Let me start, because my memory is not very well lately. The last thing I remember, which is what Rodrigo said about politicians change, laws don't, or don't so easily at least. And I'll give again an actual example. And I know we have UK colleagues here. Correct me if I do not remember the mechanics exactly. For this Lloyd's Age saga to go through, the UK government had to change the law which was applying to mergers. Now, if I understood well, and that is where I would need the assistance of my UK friends and colleagues here, the UK government used an exception in the Terror Act, which the UK had instituted after the 2005 attacks, which enabled it within 1 week to pass emergency legislation on different issues. I can see you smiling, so I'm not entirely wrong. Okay, so the UK government used the Terror Act to change the competition law to allow the UK government to have the final say in this deal. Rightly or wrongly, history will tell us the first few signs are not been very positive, but we will still wait to see. But that brings me to my second point. Do we need to be pragmatic? And that's, I think, one of the comments I was trying to make in the presentation. Yes, we need to be pragmatic. Because when the mess hits the fan, we cannot be sitting under it just watching it. We need to react. And we need to react in a way that will actually sustain the system. Which then again comes the other point that Rodrigo made. Let's make sure though that the exception doesn't become the norm. I completely agree that if we're facing a systemic crisis, we need to react. But let's make sure that because of bad precedent, forget the word bad, let me rephrase. Because of precedents which may not have worked so well in the end, let's make sure that we are not using either the new exception now in the competition law, which was introduced for this one deal. This is still there. This creates precedents, and this has affected the integrity of the competition system in the UK as it is. So let's make sure that this does not have these bad precedents, and I did use a word I couldn't help it anymore, do not actually create any further longer-term impact than the actual short-term benefit that we actually get. Now, I'm going back in time, and I'm going back to the contradictories. SRM contradictory to the state aid? No. Why? Because SRM does not affect state aid. SRM says, if it's state aid, go and deal with it. I, as SRM, will not actually, I cannot assess what is state aid and what is not. Member states go to the Commission, make sure that whatever plan you bring under this new resolution, that it's not illegal on the days of state aid. And just to finish with a positive note, because I may have sounded as Europhobic. I don't know if I'm a Euro lover, but I'm not Europhobic as such. It's, I think, generally agreed, and I know I use harsh words, that the EU reaction was much better than the US reaction. We were at an event at the American Antitrust Institute last June with US colleagues, and the general feedback we got is that EU reacted rightly, wrongly, exposed ex ante, but the EU had a reaction mechanism. US didn't. So EU did react in a positive way. And this new resolution and all these other initiatives that are being taken into consideration, all of these, in my opinion, are steps towards an even better reaction next time. I just wanted to emphasize in the presentation the practicalities that are raised, because the tools that you will use in trying to solve the problem have another impact which needs to be taken into account and needs to inform what kind of plans you will put under this new mechanism in the first place. Thank you. It was not 2 minutes, but still thank you.
Manuel, please.
Okay. 2 minutes for all these issues, but I'll start by the idea of finding solutions or punishing or preventing and so on. I think that in the case of banks there was a much more pragmatic approach and it was focused on solutions. In the case of rescuing countries it was much more focused on punishing, and that is the reason why there was no solution. And I think that finding solutions in the short run should take us from preventing the problems again in the future. And I think the idea of focusing too much on moral hazard and punishment as the only way of preventing moral hazard is a very simplistic way of seeing it. The lack of institutions and the lack of mechanisms to prevent some of the wrongdoings, it's much more important to work on these issues than to punish a lot some of the players now, because other players in the future may do the wrongdoings again if these mechanisms are not put in place. Another thing that I think but I think Rodrigo already, but I would like to emphasize this, is that moral hazard is a problem, but destroying the confidence in contracts is a really, really huge problem. We cannot deal in the European Union in a way that people start looking at the European Union, which is a place in the world that is aging, with slow growth, with a lot of things that are not the best in the world, but it respects contracts. It is a reliable place to be. And when we have solutions that are not solutions, like the one we had in Cyprus, I don't know. Should I put my money in an African country, in South America, or in a European country that is doing these things? And no offense to other regions in the world, but Europe had that on that side, and the institutions of Europe cannot destroy this important capital, which is something that we were quite proud of. And we already destroyed a lot of this, and we already have to remedy a lot of this. Another thing which has to do with preventing and mechanisms to prevent and to reinforce the powers of institutions, but not to make this power of institutions block the other institutions that are governments from reacting. It has to do with the architecture. The architecture of the euro, I started by that, was completely unfinished. People were happy about it when things were going right. It's like being in the boat that if a storm comes, it would sink, but well, the weather is so good today, so why worry about that? But another thing is the way they work, and the way power within institutions and power of national governments in the institutions can bend the institutions is something that really worries me and puts into question a lot of the European project. I could go for a lot of examples, but I like the Spanish cucumber example. Authorities that supervise food safety should be independent, evidence-based and technical. And when the German authorities decided that the Spanish cucumber was infecting a lot of Germans and killing people, it decided in not any of these manners, no evidence-based, did not prevent the problem, people kept on dying, and I don't know how the Germans accepted that, because of this bad diagnosis, there were more Germans dying than there should be. But the other thing is that this was very damaging to the industry of cucumbers in Spain, and cucumbers are very important for Greek salad and for other important dishes. So there was problems there that are real, but it's mostly the leverage. After a while, there were the Turkish, I think, tomatoes or whatever. A lot of other vegetables were being blamed, but in the end, probably this kind of material were coming from meat, and Germany is the biggest meat exporter in the European Union. And there was no one talking about the ban of export of German meat. And I don't know if there was evidence enough to do that, but there was more evidence to put that forward. All the cases were happening in the same country, so this country had a problem, and he was exporting products that could export this problem.
And there was nobody said that, well, maybe we should investigate into that, and I'm pretty sure that if the same problem was happening in a small country like Portugal or Greece, the ban to exports of this product would last for months and would destroy the industry in this country. And this way institutions are working, are very worried, and if we are going to have a central banking, it's good that it acts on the rules that are similar to everyone and doesn't differentiate the bank from Germany from the bank from Portugal or Greece, and acts on evidence-based. I don't want to explain too much, but I want to. Okay, thank you.
Thank you very much. Manuel, Rodrigo, and Yanni, thank you very much. Please, I will kindly ask you to give your interviews after we finish the roundtable discussion at 1:30 in this room. Ladies and gentlemen, thank you very much, and we will reconvene on 11:45.